Is earnings. It is the biggest week of second quarter earnings season so far. 13 Dow components are set to report their second quarter. It comes as the major market indices hover near all-time highs. Joining me right now is Allianz Chief Economic Advisor, Mohamed El-Erian. Mohamed, it's always a pleasure to see you. Thanks so much for joining us.
Thank you, Maria.
First, let me get your take on what we're seeing in terms of earnings. Really, the backdrop in terms of investing in equities is earnings, and we are entering the busiest week of the quarter so far. What's your take?
It's a good time for earnings, and for good reasons. One, financial conditions are very loose. Two, balance sheets are very resilient. And three, certain sectors are benefiting from exciting innovation. The problem, Maria, is that the benefits of all that is contained to financial markets. It hasn't spilled over yet into materially higher economic growth.
Okay, so when would you expect that to happen? Or do we need to see fiscal reform in order to really move the needle on economic growth, Mohamed?
We need to see implementation of pro-growth policies. So deregulation, which is advancing, tax reform, infrastructure, and then we need to focus also on labor retraining, retooling, and education. This economy is capable of growing a lot more than 2% per year.
Yeah, we were just talking about this on the panel, Mohamed, and Lindsay Bell made it an interesting observation that, you know, we're looking at some risks in this market. We wondered what you thought. What is the big risk to the market right now? You've got the Dow Industrials up almost 18% since Election Day, the S&P up 15.5%, and the NASDAQ Composite up 23%. We're all looking at all-time highs, or the market's near all-time highs. What do you think is the risk to this market? Is it the fundamental backdrop? Is it the central banks of the world, or valuations, or something else?
So the reason why markets have done so well, even though the economy hasn't improved as much as it could, is because of liquidity. There's a tremendous amount of liquidity getting into this market, from central banks, the ECB and the Bank of Japan, from corporate balance sheets. You just talked about another merger and acquisition. There's lots of higher dividends, lots of stock buybacks, and from individual investors. So the biggest risk is that that liquidity cannot maintain what has become a big difference between valuations and fundamentals.
So what do you think then? I mean, the Federal Reserve is about to raise interest rates in September. Obviously, we know that the Fed wants to do 3 hikes in 2017. Do you think the Fed is going to start raising rates just at this moment where we're just beginning to see traction in this economy and sort of smash any recovery that we saw?
I'm not sure they're going to hike in September. In fact, we have a Fed meeting this week, and we're going to hear 3 things from them on Wednesday. One, they're going to become more cautious about the economy, especially about inflation. Inflation is a worry for them. It's not high enough. 2, they're going to suggest that we still get a rate hike this year, but they're going to push it back more to December. And 3, they're going to explain to us that their balance sheet reduction is going to be like watching paint dry. They're going to tell markets, don't get excited. There's nothing here that you should worry about. Well,
it's interesting that you say that, because just new this morning, the International Monetary Fund is actually trimming its economic growth forecast for the United States for 2017 as well as next year in 2018. The reason is they say that the assumption that fiscal policy will be less expansionary than previously assumed. So the IMF, Mohamed, is looking for economic growth in this year of 2.1%. And in 2018 of 2.1% as well. Not good numbers.
And 18 is the big revision, because they were at 2.5 and now they're at 2.1. And they've just joined markets in realizing that despite Republican majorities in both houses of Congress, not much is getting done on Capitol Hill. So they are delaying the impact of tax reform, of infrastructure. And it speaks to a fundamental frustration, which is soft data. Sentiment has improved significantly, but hard data isn't, because people are waiting to see implementations of pro-growth policies on Capitol Hill.
So is that one of the reasons you think that the Fed is going to push the interest rate hike to December? I mean, you said you think this week the Fed is going to push that interest rate hike from September to December.
Yeah, what it's going to do is going to get closer to what market thinks. So markets think that about a 10% probability of a hike in September and about 50% in December. I think September is right. I think December is probably a higher probability than 50%. But the Fed is going to basically say the economy is somewhat weaker than it was before. Inflation is not picking up. And it's going to hint at being slower on rate hikes.
Mohamed, how will markets react to that, do you think?
I think markets have priced that in. I don't think markets expect the Fed to be aggressive. So I think markets have priced that in. Markets are going to look at corporate earnings, and they're going to keep an eye on Washington, D.C.
We've also been watching Europe, Mohamed. There's a quiet but increasing bullishness going on right now in Europe. We had some money managers on recently who said you want to be putting money there. Do you agree with that?
I did agree with that. What's happened recently is that the euro has strengthened tremendously because people have revised up their growth prospects for Europe. They think the ECB is going to be less dovish, and there's a tremendous amount of money already going into European markets. So now the exchange rate is somewhat of a problem if you're investing in European markets. And ironically, the weaker dollar is going to make the U.S. market more attractive.
So it's interesting because the dollar has come under selling pressure, obviously, against the euro. And you think that this is going to make the dollar more attractive or just U.S. equities more attractive?
So I think it's going to do both. We've had a 9% weakening in the dollar since the beginning of the year. That's a big move. What does that mean? It means U.S. companies will be more competitive abroad. It will also make the U.S. markets in international terms cheaper. So I think that is going to help longer term in terms of the U.S. And the key thing is to keep this currency depreciation orderly. That's really important.